Hey, good morning, everybody. Welcome to a Wednesday. It is 9/11 day, so you've probably seen already this morning several of the memorials. I think back to where I was sitting at Holloman Air Force Base, changed my life. Of course, like everybody else's out there, not only was I in the military and went off to fight an eventual war over this, but certainly thinking of things differently from our country actually being attacked on our home soil. So quite a day in our history. So please take a few minutes to reflect upon that. For our topics for you today, we're going to tie it back to the markets. We got an inflation number this morning. Said inflation's going up a little bit. We'll see what Michael talked to us about that and what that means for the markets, potential rate cuts, and all of that. And he will tie that into the cost of living allowance that is tied to Social Security, is tied to also military retirement, if you happen to be retired military out there, to see if that's going to keep pace with what's going on or not. So Michael will talk to that and maybe show you a chart of how that's been over the past few years. And then I will conclude with a very specific topic. But if you're fortunate enough out there to even be eligible for an HSA, and hopefully you max that HSA out there because it's the best deal going as far as the tax advantages of it, there is a way to take traditional IRA money and fund an HSA. But you got to listen to the end to find out about that. So it's a financial education presentation. So you please do your own due diligence for acting upon anything you hear in this presentation. More disclosure information is available at ankerstarwealth.com, and the opinions expressed are Mike and mine alone. So Mike, where were you on 9/11? Then you can tell us about inflation.
Yeah. Obviously a very somber day. 9/11, I was in Maine. I was in the office when it all happened. Our office, we worked with a lot of people. We had in Connecticut, in New York. So we had lots of friends in Connecticut, in New York, so real close to there. I didn't know anybody that was actually in the building, but there was people around it, people that had been there a few days before. And, everybody was like, we went down to the gym in the office because they had TVs in there, and all of us were crowded around watching those TVs back then. So it was, and then there's people making phone calls to people they knew down there. So
oh yeah.
And just a month ago, Trish and I went and visited New York City and went by the memorial, and you see those I don't know, the gap, how far down they go, and it's all the names written alongside of it, and it's powerful, it's emotional, and it's probably in my lifetime, it has to be, I think, the biggest geopolitical event, incredible attack on our soil, never expected, and just tragic. So
yeah, you bet.
Well, let's get to the market, which is a lighter topic. But anyways, consumer prices rose 0.2% as expected. So, but still the lowest rate since 2021. This was in line with what everyone expected. And I'm going to go into the market effects next. But here's what it does, is it confirms that inflation is under control as much as they thought. The inflation rate's 2.5%, which means its prices still go up. I always want to reiterate, prices still go up, but at a slowing rate. They're never going to go back to 5 years ago, unfortunately. I think some people think that's what a reset is. But with this number, it confirmed that most likely, and I say most likely because they have it data-wise, 85% chance the Fed's going to raise a quarter point September 18th. That's a week from now. That's some people were hoping, markets, we want more sugar, cheap money. We wanted to come down to 0.5%. There's a 15% chance of that, but with only one more piece of inflation information coming out later this week, it's very unlikely. So so what is the market doing with things coming in as expected? Well, the market's selling off a bit. The Dow's down 650 plus points, NASDAQ 1.34%, Russell down 1.7. Yesterday it was up. So, things go up, things go down. On the week, I could pull it back. We're probably neutral. I'll say that while they may be listing this as the headline, the hopes dim for more aggressive Fed rate cuts. Steve said this shows mine and Steve's opinion. Here's my opinion. I think the market was already starting to price in maybe a Trump victory, and the market does not like uncertainty. And I think we're getting more uncertain with the presidential elections from debates and numbers. So the market wants certainty. And I think right now we don't know. And I think the market's pricing some of that in. I know this is getting it all credited to the lack of a more aggressive Fed rate cut. Well, just so you know, a week ago, it was the same way. It wasn't like there was that much chance of a 50-point race cut. So I'm attributing it more to the debate last night and uncertainty coming in. And I certainly expect that uncertainty to probably go all the way through November. So, you can look at that as like, oh, I hate to see my accounts down today, which of course we all do. And you could also say, hey, there's some buying opportunities. Today, there's a buying opportunity. I can get stuff on sale. Could it go down tomorrow again? Yes, it could. So we just got to kind of remember that as we go in. So with inflation coming under control, that seems like, oh, I love that. Win, win, win. We all want inflation under control. The one time maybe that you at least want the number to be higher is if you get cost of living increases. So the higher the inflation, the higher your cost of living increase goes in. I don't have any accounts that get this benefit. I mean, certainly I have a house and I have stocks, so I do have hedges against inflation, but this is a very directly correlated one. So what they're already projecting is, and here's a preparation for you that get the COLA, 2.5% for next year. Yeah, the annual inflation this year is 2.5. They're projecting next year's 2.5. It's not an incredible math formula there. So what has it done previously? And I'll just scroll down, and there's things like 71 million Americans get Social Security, income beneficiaries. So it makes a difference to 71 million people. That's a lot. That's like 1/4 of our country, almost. But here's the past chart, and you can see that for a while, from 2015 through 2022, I mean, inflation really, maybe even you could even say since 2010, inflation overall was very much under control. The Fed funds rate very low, and then in the last few years, you see that big old spike. I don't know how many of us got the benefits back in 1980. I heard rumors of that when I was like 10 years old, but so now we're seeing these biggest spikes in a while. So 3.2 this year, 2.5 next year. You're just seeing those numbers. And if you're a planner and you're like, I have a fixed income, and you can kind of say that's what I get more. So if my electricity, if my internet bill, if my auto insurance goes up by whatever percent, how do I make that work? So it's just kind of an early look at that number. I'm sure when that number actually comes out, we will definitely be reporting on it. So with that, I will turn it back over to you, Steve.
Yeah, you bet. And it comes out first week of October every year. And there's only so much it can move from that 2.5% because it averages like I think it's 3 months together. I think it's the CPIW. So anyhow, the formula is kind of set, so it can't change too much. So yeah, that's what you can really expect there. So yeah, I agree that maybe some of this market sell-off today was due to the debate. And I didn't watch it, but I always catch it afterwards, the highlights. And I think that there was kind of unexpected underperformance on Trump's side and a better debate performance, not what they're saying, but just for the individuals. The performance was far more matched than I think what people expected. And I think it's funny because because now the Democrats, I think that, oh, they want to get back in the debate game now. It's like, I don't know that you do, but anyhow, we shall see. All right, transitioning to my topic of the day is, first of all, health savings accounts. What are they? If you don't have one, you probably aren't eligible for one, to be honest, because most HR departments are pretty good at making sure you know about this, because it is really the best deal going. When I say the best deal going, I'm talking about either a tax break up front, which it has, where you put money in, and get a tax break off your income. And then there's growing tax free, where you're not taxed on the appreciation, which is another great thing. And then the triple whammy is you're not taxed on the backside when you draw it out. So it's kind of like the best deal out there. And again, they're set up, the whole idea was, let's put money away for healthcare. It's limited annually, so $4,150 a person. So if you're married, $8,300 for you and your spouse there. Excuse me. Which isn't a lot of money, but if you're putting, if you're socking away 8.3K a year, that can add up. And then certainly how you spend it is up to you. Since it has so many tax advantages, a lot of people don't necessarily spend these, and they can get up into the six figures, just like an IRA, get to it for some years and it grows. And some HSAs are like 401ks where you just have a small menu. Schwab actually has an HSA version that you can have your HSA with Schwab. I have a couple accounts doing that, a couple of clients doing that. But you can grow that money, and then how you spend it is kind of a different story. But the question a client asked me, and this is a client that's approaching 65, where you can't put into an HSA anymore, which, okay, that seems like a long way away for some people, but when you just turn 55, it's like, 10 years. Okay. So it's becoming more real. But in that case, you do have the option to transfer money from a traditional IRA, which is problematic anyway, right? In a perfect world, you want everything into your Roth, right? So when you don't get taxed later. But if you have a nice big traditional IRA, A, good for you, B, bad for you, because we'll be paying taxes on that eventually. But it allows you to transfer a portion of this into an HSA one time. So I got excited because a client told me something I didn't know about. I was like, I'll look it up, but you sir seem confident. And he goes, yeah, I think you can do it once. The question is how much? Okay, how much? Again, Investopedia is our source here. Yes, you can do it. All of the what is it, all of the stuff I just told you. What's the rule? One time, and then the limits are exactly the same as your annual limits. So that's kind of the wah, wah, wah. So instead of one time, so you'd probably do this when you're 64, right? Instead of funding it with money that your employment money, your income, if you will, you can choose to not fund it with that and fund it with traditional IRA funds, which seems like a smart move. And then you have to keep it open for at least 12 months or some other little rules. And here that, unless you're just trying to pull a fast one, you're not going to trip any of those rules, right? If you're just doing normal things. But yeah, that's something to consider. I didn't know about this until the past couple of days. So again, if you're married, up to $8,300 into the HSAs there, you're $4,150 each, if you will, and then let that continue to grow during your lifetime. And again, you can only do that one time, so there's no hurry to do it. I would wait till later in life and do it. Would be my preference, but your personal situation may differ. Mike, any experiences with HSAs? I don't have one because I came out of the military into a small business, so I never got one.
Yes, I worked for healthcare insurance companies before, so I'm very familiar with HSAs and have used them successfully. I mean, it's a great investment as far as you can put money into it, by your paycheck, which is pre-tax. And then once it reaches a certain threshold, in my experience, you were able to invest after that. You were able to invest anything in addition to like a couple thousand. And then it's very easy because then you have an HSA card. And when you have a medical bill, a doctor bill, even certain, picking up of pharmaceuticals, you just scan your HSA card, it comes out right against it. So essentially, you're not paying tax on that money ever. I mean, it's pre-tax, it grows tax-free, and when you spend it, you don't have to pay tax on it. So it is that triple tax advantage. HSAs are good things. If you have an HSA, obviously you always want to fund your Roth and you want to get your 401k match. Don't miss out on those. But an HSA is a high priority in the options.
Yeah, you bet. Appreciate your perspective there. All right, everybody, let's get back to our workday. Thanks you so much for listening in, and we will catch you guys tomorrow. Have a good one. Bye.